Welcome back, team, to the next part in the Beginner to Winner series. We've moved out of our market structure and our supply and demand zone sections. We're now into kind of trade entries, how we set up for trades, how we start entering positions, where we're looking for targets and things like that. So the first thing I want to talk you through is my 3-2 technique, which is the basis of all of my entries. I'm going to split this into 3 or 4 parts, really, just to make it a bit easier, bite-sized chunks. I think is the best way to learn this sort of stuff. So this is part 1. The 3-2 technique is the foundation of all of my trading setups. We use market structure primarily, of course, and we use supply and demand to find our zones. And then this is the technique that I use to signal my entries and to get me into trades. If you haven't done so already, please make sure you check out the Instagram at StrongMoneyForex. Make sure you subscribe to the YouTube channel, like and comment below, and ask me any questions that you have, and I'll answer every single one. Now, don't forget, we've got the Discord mentorship group. There are a few spaces left in the group. I'm going to open up the doors to another kind of 40-50 members, and then they are shut forever, okay? So it's going to fill up quick. If you want to talk to me about that, or get any more information on that, or find out a bit more about the Discord group and the mentorship group, it is completely for free for the time being. Send me a message on @StrongMoneyForex. That's my Instagram, @StrongMoneyForex. Right, so the first big question is, what is the 3-2 technique? So the 3-2 technique is 2 different ways for you to qualify and to enter into trade using specific time frames. Now, my style of trading is kind of halfway between swing trading and day trading. I will sometimes hold a position for maybe 1, 2, sometimes 3 days, sometimes over the weekend. But generally, I'm looking for a kind of a day swing, if that's the way to look at it. So rather than, where you see on these charts, this is a daily chart on gold, rather than targeting this entire move down, what I'd be more looking for is getting into a trade and then taking out kind of liquidity points and then exiting, okay? And then I might get into another trade to take out the next liquidity point and then exiting. So I've always kind of looked at it as swing trading, but really it is, it's halfway between day trading and swing trading. So whereas a swing trader would be effectively getting here let's just zoom in so you can see that clearer, okay? A swing trader would be taking one trade from somewhere near the top and holding it all the way down, and that might take a few weeks to play out. For me, what I'm doing is I'm taking 1, 2, 3, 4 different positions and closing them when I reach targets. That, for a lot of people, is kind of, it satisfies your appetite. It gives you regular trading and regular profits, and allows you to kind of get in and out of the market nice and quickly. Now, I've got a couple of examples I'm going to show you of how to use this. I'm going to talk through in its kind of rawest sense what it is, okay? The first time frames that we use in the 3 technique are anywhere above the 1 hour chart, really, okay? So on a 2 hour chart, 4 hour chart, or daily, okay, we're looking for, very simply, a confirmed trend and then a test of supply in premium level, okay? Just to keep it really nice and simple, that's our supply and demand area, that's our range, okay? So we've got premium discount there. We've broken structure twice, so we've got our 2 breaks of structure, one there, break of structure below, and then we've got another one down here, okay? So we've now got a confirmed downtrend. We draw out our range, okay, of the last swing that was broken, okay? Imagine this isn't here for now, okay? We've drawn out our range of the last swing that was broken. We now know that when price gets into these kind of premium areas up here, this is an area we're going to be looking for shorts from, okay? So price comes back into here, and this is when we drop down to our next time frame, okay? So the next time frame would be down on the 15 or the 30-minute time frame. Let's use the 30 minutes just for this example's sake, okay? We've now got our daily range, okay? This is the area that we're looking for trades from, and let's say we have a really nice supply zone in here, okay? So the next thing we're looking for is a change of structure, okay, and a confirmation that we're going to go down, which is our trend bias, okay, on the 15 or the 30-minute time frame. So what we're looking for is price to come into zone. Let me just draw it out for you, okay, and give us some clear signs that it wants to reverse. Okay, failure to make a new high is usually the first, and then a retest before the drop down. Okay, so what we're looking for here effectively is this kind of slowing in momentum, the arcing shape that we look for. Failure to make a new high, that's our first signal, and then ultimately a break of structure, ideally major structural breaks is what we're looking for, and that now it gives us the 2 in our 3. So this is our 3 technique. Okay, the first time frame is above the hourly, so 1 hour, 2 hour, 4 hour daily. Okay, the higher time frames work better for this, I find. Okay, the second time frame we use is the 15, the 30 minute, or the 1 hour. Okay, and then the last time frame that we're going to use is going to be the 5 minute time frame or below. Okay, so what we're doing is we're stacking multiple time frames in our favor, in our confluences, in order to make sure that we are trading in line with higher time frame bias. We know price wants to go down from this 2 hour, from this 4 hour daily, whatever it may be. We know that price wants to go down from this first time frame. Okay, we know we're heavily bearish. What we've now done is we've lined up a second time frame. Let's say, for argument's sake, this one is on the 30 minute or the hour. Okay, so at the top end, you're looking at anything above 1 hour. So that's your first. The second, you're looking at 15:30 or the 1 hour. And then the last one ultimately is your lower time frames, which is your 3 minutes or your 5 minutes. So the last time frame now is going to be anything below the 15 minute. Now, what we're looking at here effectively is, say, a 3 minute or a 5 minute trend change as well. Within here, these zones, you're going to have these smaller trends as well. Okay, you're going to have these kind of motions happening, and the same thing happening on lower time frames, of course. Okay, the same sort of motions. Okay, what we're looking for is, and this is what a lot of people miss and fail to see, if you wait for price to enter this zone and then you just wait for a very low time frame, so if you're looking at a higher time frame zone like a 4 hour or a daily zone, and then you wait for a change of structure on something like the 3 minute, okay, the time frames are too far apart from each other. And the problem with that is you might catch a move, but it's probably just going to be a short move. Okay, the key to this, and the reason why the 3 technique works so well, is after you've waited for the change of structure on your medium time frame. Okay, so we know we're in a downtrend on the daily. Okay, we've now got this confirmed downtrend on the 15:30 1 hour. Okay, whatever the time frame may be, it's up to you and up to your trade. Okay, after that event has happened, that's when we can start now looking for lower time frame breaks of structure in order to hopefully catch these longer moves. Okay, and this is what a lot of people fail to see. When you're looking at high probability zones and higher time frame zones, the smaller time frame or the lower time frame trend changes may not give you the big moves. And let's say you were going to hold this until the liquidity low here, you might have actually got stopped at a break even if you've managed to trade well. So waiting for the medium time frame to line up with the lower time frame is really, really key. Okay, and what I would have done in this situation, let's just say that kind of meandered down as it normally does, just for simplicity. Okay, so we'll do something like that. Now we've had that break of structure, what we're looking for is exactly the same thing, but now the chance of this kind of running out liquidity lows to the left and these bigger liquidity lows here is much higher because we've had that break of structure on the medium time frame. So that's the third time frame that you're looking at. Okay, the 1 minute, I don't like the 1 minute, but you can use it, the 1 minute, the 3 minute, 5 minute. Okay, so that's the key to the 3 technique, is finding a zone on the 4 hour, 2 hour daily, something above the hour anyway, using then a trend change on the 15, the 30 or the 1 hour. Okay, and then once you've got that, finding zones in these areas. So you know what I would have done then is I would have found a supply zone here, a refined zone within obviously the higher daily zone. Okay, a refined zone then that I can then look for my trades from. And then once we've got these trend change on the lower time frame, we've now got a confirmed move with 3 time frames stacked in our favor, but B, we have a much higher chance now of price running out these liquidity lows. And if you're ambitious, you can then hold these trades. Okay, if you are ambitious, you can hold these trades if you want, all the way down to this liquidity low, which you might hit over a few days time, and that's sometimes how I like to trade, and you get yourself a lovely 12R instead of just using the medium time frame, which would have got you a 4R, or just using the daily time frame, which would have gotten you a probably 3R. Okay, so this is how I refine my trade zones and how I stack these confidence in my favor. What's most important that a lot of you will be missing right now is the higher probability, higher time frame zones. They are very, very reliable. The problem that people have is they don't wait for enough confirmation. So they see a 3-minute change of structure, or the break of structure, or chalk, or whatever you call it, and then they enter, and then they wonder why they get stopped out and they don't catch the trade, or it pushes up higher again. The reason why is you've not let that second time frame, which for our example is the 15, the 30, or the 1 hour, you've not let that second time frame line up with the higher time frame trend. Once that second time frame lines up, you can now use the lower time frame using a refined zone like this zone here. Okay, that's what you're missing. Okay, so I'm going to talk you through an example of the 3 technique, okay, and then I'm going to go through the 2 technique, which is my kind of main technique that I use, how I use it, what I'm looking for. So make sure you stay tuned to the end. Thank you team for checking in on this video. If you've enjoyed this content, make sure you click this next video here. This is going to show you exactly what I look for when I'm trading, and this is guaranteed to increase your results.